Hey guys, it's a bald Indian here and congratulations. We have inflation. Earlier this year, Fed Secretary Jeremy Powell did mention that inflation is transitory. But based on recent economic data, it's getting much worse and it's not expected to stop anytime soon. But wait, what is inflation and what is causing it? As per Investopedia, inflation is the rate of which value of currency is falling and consequently the prices of goods and services is on the rise. Inflation is more like a hidden tax that not everyone is aware of. Did you know the things that you were able to buy for $1 in 1950, it would almost cost $11.48 in 2021. That's almost 10x accounting for inflation. In other words, $1 in 1950 is more or less 9 cents in 2021. The inflation rate in US raised to 6.2% in October 2021, the highest in last 31 years since November 1990. But what did cause inflation to hit all-time high in 31 years? But before we move ahead, I would really appreciate if we can inflate that like and subscribe button. It means a lot to me. Okay, moving on. You would like to believe that Jeremy Powell and his money printing might have caused this crazy inflation. But things are much more worse than that, even though it was one of the major reasons. Inflation has been on the rise since November of last year as economy reopens, and this did lead to high consumer demand. The Consumer Price Index (CPI) and the Producer Price Index (PPI) are one of the key indicators published by US Bureau of Labor and Statistics, which measures price changes in goods and services produced and consumed in United States. This graph shows year-over-year change in CPI and PPI from November 2010. As you can see, the Producer Price Index has increased almost 7.7% year-over-year, while Consumer Price Index, which is CPI, rose 5.3% in July of this year. As you can see in the far right of the chart, the PPI has been growing at a really fast pace, but CPI is still catching up. This just suggests that higher prices for consumers is inevitable. But why did Producer Price Index spike since last year? It's all about basic fundamentals of economics, which is supply and demand. As we were hit by pandemic last year, there were a lot of supply shortages in US, mostly caused due to Suez Canal issue, as well as ton of shipping containers backed up at US ports due to labor shortages, truck driver shortages, and much more. The reduction of supply coupled with increased consumer demand are major catalyst for recent spike in inflation. But there is another significant factor which has caused inflation, which is government spending, or also called as money printing. Did you know the 18% of the total US money supply was created in 2020? It means $1 in $5 were created in 2020. For most of the past year and a half, Fed has been buying $120 billion worth of bonds each month, providing unprecedented support to the financial market. This bond purchases had added $4 trillion to the Fed's balance sheet, which now in total stands at $8.5 trillion, and about $7 trillion of those assets were bought through quantitative easing program by the Fed. This bond purchases have helped to keep the interest rate at historical low levels and also provided support to the market that malfunctioned at the beginning of the pandemic, but has also been the major driver of inflation. On November 3rd, Fed did announce that it is going to start tapering, where it will reduce the bond purchasing by $15 billion each month and plans to end this program by June of next year. This tapering process will definitely help to keep inflation in control, but as there are so many factors that are affecting inflation, it is hard to say anything. If you want to learn more about tapering and the history of tapering, I have created a video recently around tapering. So please feel free to check that out. So now that I have gave you the overview of inflation and what might have caused it. So here are 3 things that you can do in order to build wealth during inflation. Number 1, save money and build credit. So the first thing that you should do, you should reassess how you're spending money. You don't spend money or purchase anything that you don't need. And even though if you need to spend money, make sure you use credit cards, especially cashback credit cards. You have to make sure that you keep most of the money that you make. In addition to that, you should look for offers around gift cards. At this time of the year, there are several retailers who are offering gift cards at 5 to 10% discount, and then you can use those gift cards to do your daily purchase. For example, currently there are retailers like Macy's, H&M, Express, Gap, app which are offering 10% discounts on gift cards. That means you can buy a $100 gift card for $90. And in addition to that, you can buy those gift cards using the cashback credit cards, and you will get 2 to 5% cashback on your credit card. But also make sure that you pay those credit cards on month-to-month basis and you don't have any outstanding balances. I also created a video around credit cards and what are the 4 factors that affect your credit score. Please feel free to check it out. Number 2, increase your debt by buying real estate. Buying real estate using the credit that you have built over time is the best thing that you can do during inflation. Real estate can be a good hedge against inflation because property value over time tend to stay on an upward curve. Inflation benefits real estate investors who are earning their income from rental properties, especially short-term lease structures like multifamily homes, because higher home prices often equal to higher rent, and this will give you an opportunity to keep that money in your pocket. And this takes me to the third point, which is buy assets. In addition to real estate, it's also said that buying tech stocks, crypto, and gold can also work in your favor during inflation. I think there is a good amount of content on YouTube on how you should invest in this type of assets during inflation. I'll make sure to link few of those videos in the description below. And that takes me to the last point, which is not applicable for everyone but majority of the Americans, which is negotiate your salary. You should negotiate your salary to adjust for inflation with your employer. I think this is the perfect time of the year where you should have these salary conversations with your manager. Make sure you do mention the rising inflation and how it will affect your salary. On an average, an American gets a 3% raise year over year in their salary. But that's not going to cut it this year. If you get anything less than 5% raise in your salary next year, you will be losing money. So make sure you do bring this up to your manager. So that is for today, guys. Hope I was able to provide you some value today. Please drop a like if you like this video. Do check out my other videos regarding personal finance, and see you in the next one.